Well, welcome everyone. My name is Christopher Leppert, and I am the State Executive Vice President. And it's my pleasure today to introduce Alex Smith from Acra Lending. Acra Lending was one of our sponsors at the state convention, and part of their sponsorship allows them this Zoom presentation to get their products and the knowledge out there. So we do appreciate Acra Lending, Alex, and your support of the FAMP over and over again. A little bit about Alex Smith. He's the area sales manager at Acra Lending and has been with the company for over 3 years. His knowledge and his assistance has proven invaluable to his AEs and his broker partners. He manages a team of 6 Florida AEs who have risen to be one of the top performing non-QM teams in the country. Alex personally is based in Clearwater, and 80% of their staff are remote. Today, he's going to be sharing his insight and giving pointers to help us close more loans in this tough market. Couple housekeeping items. Everyone will be muted. The chat box is open. Courtney Ham from our association will be handling that chat box, and Alex will be stopping throughout his presentation to be able to answer some of your questions, and there'll be a Q&A at the end. Okay, Alex loves it if you would have your cameras on, one-on-one personality. If you can't, we understand, and that's okay. But if you'd like to turn your camera on, we'd love to see you live. So at this time, Alex Smith.
Hey guys, welcome. Thanks for joining us here today. I'm excited to go over the top 10 things that everyone should know about non-QM. This is not going to be just a, hey, here's why you should use Acra Lending pitch. This is going to be an actual, a true top 10 things that everyone should know. If you are going to be looking at non-QM loans this year, my encouragement is pay good attention, take some good notes, maybe get a copy of this presentation when it's all said and done. We're just going to go kind of right on down here. So Courtney, if you want to take us off to the next one, we'll get started. So here's the list of the items we're going to go over. I'm not going to read them now because we're going to go through them. So Courtney, if you want to take us to the next one, I'd like to give us like kind of an introduction to what a non-QM loan is. In short, non-QM loans come in 2 main flavors. There's a lot of other nuances that can go in, but the truth is I always like to think of the 80-20 rule, which is if you can remember 20% of the something, you're going to get 80% of the results. And that is 12-month bank statement programs and DSCR programs. That's going to account for almost all non-QM production. What is a 12-month bank statement program? It's for people who make money as self-employed, but their taxes have some creative write-offs. We take a look at their last 12 months of bank statements. We do an income calculation that way, rather than looking at the actual, tax returns with depreciations and all this other stuff. The other loans that you guys are probably familiar with, and if you're not, we'll talk about them, are called DSCR loans. Sometimes they're called investor cash flow loans. And the only thing you got to know there is, does the rents pay for the mortgage? So if you can get those 2 loan types done and understood and get the complexities wrapped around them, the truth is you're going to cover a very, very large portion of the non-QM market. So with that, we're going to get kind of started with the first one here, which is credit. Now, of course, your score is going to affect your interest rate. Every single non-QM lender is a little bit different. So some will go down to a 620, some will go down to a 600, some will go down to a 575, right? There is, every non-QM lender is going to be a little bit different. Generally, you're going to start getting best pricing once you're above a 740 or a 750. The big thing that I like to say is you got to keep an eye on your trade lines. Every single non-QM lender is going to have different things. Some places say you need 2 trade lines active in the last 12 months. Some are going to say you need 3 trade lines, one of them aged 24 months, right? Like every lender's got different something, the different overlays. And because non-QM is essentially financed with private money, you're going to need to reach out to your AE to find out. Here at Acra Lending, we want 3 trade lines aged 24 months. They can be closed though. So as long as it's still on the credit report, as in within the last 7 years, you're fine. Any collections, generally, except for medical, have to get paid if they're within the last 2 years. If they're older than 2 years, we generally let them walk away with that. However, that's going to negatively impact their score, so they might want to pay it off anyways. So that's kind of the credit requirements that you're going to see trickled out through all non-QM, whether it's us or any of our competitors. Kind of keep an eye out on what the credit we're looking for is, okay? Now, how do you issue a non-QM pre-approval? Generally, this comes in the form of bank statement loans. DSCR loans, I'm going to level with you guys. There's really not a lot to pre-approve. There's no income documents. Credit is acceptable down to 575 sometimes. I mean, you're not going to really know on a DSCR loan until the appraisal comes in. That's the truth. But on a bank statement loan, how do you calculate the income? How do you issue a pre-approval? Every single reputable non-QM lender has a version of a pre-screen. That's what we are calling when a junior underwriter analyzes the bank statements and gives you an income calculation. So my suggestion, send it in, right? Turn your bank statements into the pre-screen desk, whatever theirs is called. Let the lender calculate income for you, update your LOS, and if your DTI is under guidelines, which for most non-QM is 50%, borrower's income qualifies, right? So send a 1003 and credit to your AE so they can run their eyes over it. Say, hey, you know what? Income looks good, credit looks good, property looks good. Issue that pre-approval. And that's how you can do all of your homework up front so that you know that your name at the bottom of that pre-approval is your reputation's not at risk here, right? Like this is you can stand confidently behind your pre-approval. So that's the best practices, I would say, for issuing these pre-approvals for non-QM loans, even without experience that you guys may not have. The biggest, but a common reason borrowers need to go non-QM, or sometimes called non-prime, is because they have life events and they're all over the place. It could be short sales, deed in lieu, bankruptcies, foreclosures, forbearances, loan mods. We've seen all different versions. I can tell you prior to 2 years ago, I never heard the word forbearance, I don't think, in my life. And all of a sudden there was like a 6-month window where I felt like every single file had one. Thankfully, that's a little bit more aged out today, which is, I think, good. But bankruptcies are a common thing. And how do you handle that, right? Well, obviously, there's two main types. There's a 7 and a 13. And there's different aging requirements for the different kinds. So I'm only going to speak to what my company does, simply because the fact is every lender is going to have slightly different nuances here. For Chapter 7, that's where you just completely walk away from all your debts. We'll go off of the date of the file, or the date of the discharge when it's finally completed. For Chapter 13s, because they made monthly payments and they actually paid back all their debts, we will let you backdate that to when they first entered the Chapter 13 bankruptcy agreement. So let's say it took them a full year to complete it. Well, right off the bat, you've got a full year of seasoning, right? So that's one of the good things about a Chapter 13, of course, over a Chapter 7. Now, if we're going to actually get real nitty gritty, you do need to have a year away from foreclosure and a year away from bankruptcy per our timeline here. If you only have 1 to 2 years, we're going to price you like you're a 575 credit score. If you've got 1 extra year, 2 to 3, we're going to price you like a 675 credit score. And then, of course, if you're greater than 3, then that's good enough for us. We don't have a 7-year look back. As long as it's more than 3, we're happy to walk away and be all smiles. Forbearances are going to be a little different. Commonly in Fannie Freddie, you want to see 3 months of payments made outside of the forbearance. We don't take that stance. We look at when did they apply for the forbearance, and if they applied for the forbearance within the last 6 months, all we do is we dock them by 10% and we require some reserves. So that's, forbearances are not really super penalized. But if it's very, very recent, we kind of take the stance, hey, they just went to their lender and said, I'm having difficulty paying. That's generally a sign of having some risk. So that's where we counter that with some extra reserves, slightly lower LTV. So another common reason is quite simply unlimited cash in hand. right? Probably a good 40% of our pipeline, maybe not 40, maybe 30, is properties that are owned free and clear that they're just pulling a stupid amount of cash out on. A lot, you're going to need to, I'm going to say this a lot here, but you're going to need to contact your AE to kind of understand exactly what they're looking for. But I can tell you at Acra Lending, we don't have those common rules of you need to be on title for 6 months or your equity cannot be more than 30%, right? We look at it as first of all, if your loan is under 1.5 million, we have no cash in hand limits. If your loans are above 1.5 million, we're going to try to limit you to 500,000 cash unless your LTV is at 60, which does mean if your LTV is at 60, we'll give you a loan up to $4 to $10 million there, and that's all cash, right? So we do not have the same like cash out property ownership requirements. Now, sometimes one of the questions I get asked is about quit claims. If they purchased it via warranty deed, like on the open market, you can cash out next day. If it was just, hey, your grandmother signed the title over deed last month, all we're going to ask is that you get to 3 months before you pull cash out, which is frankly not that hard. So that's the cash out rules here. Another common one is DSCR loans. These are the investor cash flow. A very, very, very common question I get is, can a person who's renting, can a first-time home buyer purchase a property with a DSCR loan? Most lenders will say, no, you can't do that. You need to own a primary. We say, yes, you can do that. You do not need to own a primary, but there are some rules. So the first question I always ask is, can you document rent? Meaning, can I see the canceled checks? If I can see the canceled checks, I can get you all the way to the max LTV, which is 80%. Let's say they paid cash, they can't really get the canceled checks, so we're going to use a private party VOR. That's fine. I'm at 75% instead of 80. And then, of course, if you're living with family, we can't accept a VOR, or if you're living rent-free, then I'm going to have one final overlay, which is 70 LTV, and I do need positive cash flow. I see, Ed, your question, can the DSCR program be offered to clients with an ITIN number? They absolutely can. You are going to have the ITIN overlays, which for us is 75%. So a traditional borrower can qualify with 80% on a DSCR loan. Because ITINs have a limit of 75, that overlay hits into effect. And so can they do it? Absolutely, but they're going to be limited to 75 LTV. Short-term rentals. This is the one that I swear is blowing up right now. Yeah, you're very welcome, Ed. Airbnb, VRBO, Vacasa, Condotels. There's all these short-term rentals that are blowing up everywhere. How do you do them? How do you qualify them? So let's talk about them. These are DSCR loans, but you're going to specifically look in short-term rental areas. We're all in Florida here. Where is a good short-term rental area? The answer is near the beach, right? Near the beach or near Orlando. There's going to be short-term rentals everywhere, right? We do have some limitations. If it's a short-term rental, we're going to give you 75% on a purchase or 70% for a cash out. The interesting thing, and this is going to be a challenge, this is the third bullet point here, we do allow you to qualify with short-term rental data on the appraisal. However, you are going to have a challenge finding an appraiser willing to use the short-term data. Now, the solution we have is we allow you to use your own appraiser, right? Find an appraiser who's willing to do it and send it in and we'll accept it. However, I acknowledge that might be difficult. I have some recommendations for some people if you need help in certain areas, but that is a challenge to solve. How do we actually qualify them? Well, on purchases, we just go straight off of what the 1007 says. If it says rents at $500 a night times 80% occupancy, boom, that's like $4,000 a month or whatever. That's our DSCR number that we use. If it is a refinance, we're going to take a look at a last 12-month ledger and the 1007, and we're going to reconcile generally to the lower to determine what the DSCR ratio is going to be. Now, this is a common thing that's blown up right now. Everyone is interested in it. I don't want to just skip on by this. Specifically to short-term rentals, do I have any questions from anybody? It doesn't sound like it. Perfect. Awesome. Courtney. Another interesting one here, multifamily. This is essentially a DSCR loan on steroids. Instead of the traditional way of gross rents divided by PITI, which is how DSCR loans are normally calculated, multifamily is, oh, I see a question about fix and flip loans. We're going to talk about that, so that'll be good. You look at the net operating income. Generally, the industry standard is 1.25. We want a 1.25, but we allow you to go down to 1.1 and down all the way to 1.0, which is basically cash flow break even. So as long as you can break even, you generally can get a loan. You are going to have slightly reduced LTVs. A DSCR loan can traditionally go to 80. Multifamily, you're typically limited to 70. The other thing is that DSCR loans, you can close in an LLC or in a personal name. For multifamily, you got to close in an LLC. It doesn't make sense on our mind to own an apartment building with 20 units and it to just be under your name. Like it should probably be under your company name. That's just best practices. I think that's the right move for everybody. Bridge loans. So let's talk about fix and flip because that's essentially what a bridge loan is. So these are short-term loans, generally 12 months, and they get paid off very quickly. There's no yield spread or lender paid comp on these because these loans don't exist very long, right? So we can't just jack the rate up and pay you on the back end. You're going to have to charge your points up front. Fix and flips are probably the most common examples of bridge loans. If the property doesn't meet guides for traditional financing, meaning the DSCR ratio is all jacked up because there's a tenant not paying rent or there's a hole in the roof and there needs some work. I use the phrase stabilize the rents. This is a common reason. That's a phrase where savvy investors buy distressed properties, spend some time, make them profitable, and then after they're profitable, they refinance to long-term financing. A lot of you guys are familiar with the BRRRR method, the BRRR. This is the part of there where they do that. They use our bridge loans to acquire, get the work done, and then refi out of it. Generally, they have some points associated with them just because, we can't exactly sell these loans because they only exist for 4 or 5 months at a time. How fast can we close this loan? Generally, because we do need an appraisal, I generally say give me 1 to 2 weeks after the appraisal's turned in. Okay. So if you rush and order an appraisal and you get it back in 3 days, well, 3 plus 14, I can close in 17 days, right? So that's the good news. The bad news is in some markets, and you guys as originators are going to know your markets the best. Fix and flip appraisals, how fast are they coming in your area, right? If they're coming in 3 weeks, then I'm going to need 5 weeks, right? And that's something to kind of keep that in mind. I can't control the appraisal because remember, you guys order the appraisal through any appraiser that you like. So that's the takeaway there. Did I answer your question here? Let me reread this. About funding off a wholesale as well. Yeah, a lot of times fix and flip investors purchase they get their purchase contracts from wholesalers. That's totally fine. We're used to that. We'll pay out the wholesaler. That's no problem. And in fact, we'll even add it to the purchase price. So if the wholesaler fee is 15 grand and they're buying it for 200, we will say that the purchase price is 215. So that's one of the cool things. So we're expecting wholesalers to be involved on the fix and flip program. Now, unusual property types. Certain property types are going to have some challenges. Condotels, probably the #1 question I get asked, do you guys do condotels? Yes, I do, but you're going to have some LTV overlays, 70 on a purchase, 65 on a refi. Another common question I get is manufactured homes. Sure, but they need to be at least a double wide, built after 1976, can't be in a trailer park, right? That kind of thing. It is allowed though. There are not a lot of lenders that will allow manufactured homes qualifying non-QM, meaning bank statements or DSCR, but we are one of the ones that do. Same thing with rural properties. A lot of non-QM lenders won't touch rural properties. Don't know why. We'll still do it, but we have some rules where your LTV is going to be limited to 70/65. We're going to need a 650 FICO. And if it's a DSCR loan, we need to have cash flow positive or better. Yeah, you're welcome. The true log cabin homes, not going to do those, but you will see a lot of log cabin style homes, and those are allowed. It's a traditionally built home. It just kind of looks like it has the Lincoln log style, right? That's fine. But if it really is unmilled logs laying on top of each other, there's no dry, like it's truly, I mean, it's then no. And generally, in case you guys want to know, it's because those are depreciating assets. You get termites in there and the whole thing goes down. Leaseholds, co-ops, you don't see a lot of those in Florida. The Panhandle has some leaseholds, and then like the formerly New York areas like West Palm Beach is going to have some co-ops. But outside of that, you're not going to see them in Florida very often. Those ones will even us at Acra Lending, as flexible as we are, even we won't touch those simply because the market today is just too rough. I believe this is the last one, and this is an interesting one. The written VOE only. This is specifically designed for cash-heavy borrowers. Okay, can't document their income because they don't get traditional pay stubs. Right, they're wage earners. They're not 1099. Right, think servers, entertainers, magicians, valet attendants, bellhops at hotels. Right, people who get cash. They have money. They get cash. But their pay stubs might show, what do servers make? $2 an hour or something like that. Their pay stubs show nothing. How do you qualify their income? Simple. We will accept a written VOE only, and that's it. No tax returns, no pay stubs needed, just directly off of the VOE, the written one. There are really two main rules. One, we don't allow first-time home buyers on this program. And two, your LTV is going to be maxed to 80%. I had the bottom here, hint, this can be a useful marketing tool for local restaurant groups. Guys, people who work at restaurants need mortgages too, right? And a lot of times they don't even know they can qualify because they know that they don't take their tax returns that seriously. I don't know a single server who reports their tips. I really don't. But I know they make good money. I see it. I've spent time with them. They have money in their wallet. These are borrowers that if they're struggling to find a loan, this will be a great solution there for them. Let's see, Courtney, perfect. Can you take us to the next one? So again, I want to reconsider two of the big resources that my company has, if you ask me for them, is I can send you some marketing collateral. Now, if you look at the little picture there, those do not have our logos on them. They're specifically designed for you to put your logo on them. That way you can go out and meet with your realtors and go sell our programs. That way you can say, hey, listen to me. I got a bank statement program. I got a DSCR program. As you're meeting with your realtors, I'd love a chance to send all these flyers to you for you to customize yourself. Which takes me to the next one, Courtney, which is our broker portal. And can you click one more time? I believe, darn it, that's okay. The broker portal does have that pre-screen that I talked about earlier where you can upload your bank statements, okay? Christian, I see your question here. Do we lend in New York? Wait, is it New York or Nevada? NY, New York, perfect. The answer is yes, we do, but only for investment properties. If you're in New York, you're probably very familiar with the licensing, and New York's been doing this fun little trick where we apply, it says a 6-month wait, and then after 6 months, they say our application has expired. And then we just keep doing that over and over and over. So I can't get into New York for primaries, but I can for investment properties. So that's it, guys. That's the bulk of my presentation here today. I'm going to open the floor up to questions. This doesn't have to be what I just talked about. It could be about anything else that you want to hear. I am a resource, and I would love to go over everything. Please share the map. It would be useful for the group. Which map is that? I'm assuming it's which states we can originate in without a license. Is that what I'm assuming? Got it. Okay. So the fun thing here, guys, is that on DSCR loans, these are business purpose, AKA non-trade loans, which means you can originate in states that you don't have a license. There are 40 states that allow it. The only ones you really have to worry about are the West Coasters. Think California, Arizona, Nevada. If you're not going to West Coast, you don't have to worry about it. If you want a list, I'll get you the list of which states we allow you to originate without an actual lending license. Someone asked about foreign nationals. We do a lot of foreign nationals. They are built as part of our DSCR program. Okay, so remember, DSCR loans are, does the property pay for itself? We're not underwriting the borrower's income. We're not really underwriting their credit. So we're just looking cash flow. So for us, we look at a foreign national and say, do they have cash flow? Yes, put them there, right under the DSCR program. It's a great way to qualify your borrowers. Foreign national LTVs, 30% down. Rates, foreign national loans rates are high today. Guys, we know this, but we're not here because we sell low rates. We're here because we sell unique lending solutions. And that's, the big takeaway here is these kinds of loan programs that you guys can work with can really come through and secure some new realtor relationships because, people used to turn these loans down. I know a lot of originators who turned these down this time last year because the market, they were so busy with A paper. A paper's a little dried up. Every place is a little dried up. We're here still slinging BC paper for those of you guys who know that reference. Any other questions from anybody? I don't see any. So that's it from me. Guys, I'm going to throw my email address into this chat here just because I'd love for you guys to take shoot me an email if you want a copy of any of this, whether that is the PowerPoint presentation, whether that's those flyers that I mentioned, whether you want me to get you a login access to my portal. If you're not already set up with us, I'll send you a broker package so you can get set up with us. I want to be a resource here for all of you guys so that you can, take away this message of how do I originate non-QM in today's market. And I hope I did a good job explaining all of this to you.
Fantastic, Alex. Thank you very much. Great presentation. If you could also make sure that Courtney gets a copy of that PPT. Courtney, you can help facilitate getting that out to everyone who attended this meeting today. Any additional questions? All right. Well, Alex Smith, Acra Lending, thank you very much for being a big part of the FAMP. We look forward to future endeavors together. This was a great presentation, and hopefully we can make some new connections with this. And thank you for all of the education on non-QM loans.
Awesome. Guys, thank you very much for the opportunity to present to you guys. And if you ever have any questions, don't be afraid to reach out.
Fantastic. Have a great day, everyone.
Thanks, guys.